Scalping is the fastest and most demanding form of trading. Decisions happen in seconds, not minutes. There is no time to hesitate, no space for interpretation, and very little tolerance for mistakes. Execution matters more than opinion. In scalping, you're not trying to predict large market direction. You're exploiting small, short-lived price movements that appear and disappear quickly. Precision and timing define results more than analysis depth. Because trades are extremely short, preparation must happen before the trade exists. Entries, exits, and risk are defined in advance. Once price reaches your level, execution is the only job. Welcome back to the ComLucro channel. This video is part of our Types of Trading course, a structured series where we break down each trading style step by step, focusing on how they actually work in real market conditions. In this chapter, we focus on scalping as a professional trading style. We will explain how scalping works, the time frames it uses, how trading sessions are structured, and what kind of trader can realistically handle the speed, pressure, and execution demands required by this approach. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. So, what scalping trading really is? Scalping is a trading style focused on capturing very small price movements with high precision. The objective is not to catch large trends, but to take advantage of short bursts of liquidity that occur repeatedly during active market sessions. In this approach, trades are opened and closed very quickly, often within seconds or a few minutes. Because profit targets are small, consistency comes from execution quality and repetition, not from predicting where the market will go next. Scalping relies heavily on structure. Entries, stop losses, and targets must be defined before the trade happens. There is no time to analyze once price reaches the level. The decision is already made, and execution becomes the priority. For this reason, scalping is not about intuition or emotional reactions to price movement. It's about following a predefined plan under speed and pressure. When that structure is missing, scalping quickly turns into random clicking and overtrading. This distinction is critical. Scalping is not gambling. It's a highly disciplined form of trading where small edges are repeated many times with controlled risk. Now that we understand what scalping really is, the next step is to look at how it operates on the chart. Scalping is defined not only by speed, but by the time frames it uses and how long trades are held. In scalping, traders operate on the lowest time frames available. The most common are the 1-minute, 2-minute, and 5-minute charts. These time frames allow traders to observe short-term price fluctuations and react quickly to changes in liquidity. Trades are usually held for a very short period of time, often lasting only seconds or a few minutes. The exact duration matters less than the ability to execute quickly and exit without hesitation once the setup is complete, as speed and decisiveness shape the entire trading experience. So, how many trades does scalping usually involve? And how are trading sessions structured? Scalping is not about trading all day. Most scalpers focus on specific market sessions where liquidity and volatility are higher. Within these sessions, opportunities appear frequently, allowing multiple trades in a short period of time. However, this does not mean trading non-stop. Professional scalpers work with clear limits on the number of trades per session. Session structure is essential in scalping. Traders define when the session starts, when it ends, and under what conditions trading stops. Without these rules, speed turns into pressure, pressure turns into mistakes, and scalping quickly becomes overtrading instead of controlled execution. So, What are the main advantages and disadvantages of scalping? One of the biggest advantages of scalping is speed. Trades are completed quickly, which means exposure to the market is short. You are not holding positions for hours or days, and feedback comes almost immediately after each trade. Scalping also allows traders to benefit from frequent opportunities. During active sessions, the market produces many small movements, giving disciplined traders multiple chances to apply the same edge again and again. However, this speed comes at a cost. Scalping requires intense focus and sustained concentration. Even small lapses in attention can lead to execution errors, missed exits, or unnecessary losses. Transaction costs also matter more in scalping. Spreads, commissions, and execution quality have a direct impact on results because profit targets are small. Core execution can erase an edge very quickly. Scalping is mentally demanding. The constant decision-making, fast pace, and pressure to perform can lead to fatigue if sessions are not well structured. This is why scalping rewards discipline, but punishes impulsiveness more than any other trading style. So what kind of trader is suited for scalping? Scalping favors traders who are comfortable making fast decisions without hesitation. There is no time to debate or second guess once price reaches a level. Confidence in the plan is essential. This trading style requires a high tolerance for pressure. Wins and losses happen quickly, sometimes within seconds. A scalper must remain emotionally neutral, treating each trade as one repetition of a process, not as a personal outcome. Scalpers also need strong focus and presence. Distractions, multitasking, or mental fatigue quickly degrade execution quality. The ability to stay fully engaged for a short, intense session is more important than endurance. At the same time, scalping demands comfort with small, frequent losses. Not every trade will work, and losses must be accepted without emotional reaction. Traders who struggle to take quick losses often find scalping extremely frustrating. For traders who thrive under speed and structure, scalping can feel natural. For others, it can feel overwhelming. Understanding your psychological fit is critical before committing to this style. So, what are the most common mistakes beginners make when scalping? One of the biggest mistakes is entering trades without a clear plan. Scalping leaves no time to think during execution. When entries, stops, and targets are not defined in advance, decisions become emotional and inconsistent. Another common mistake is increasing position size to recover losses. Because scalping produces frequent trades, some traders try to compensate quickly after a loss. This usually leads to overexposure and rapid drawdowns. Many beginners also underestimate fatigue. Scalping requires intense concentration, and trading while tired or distracted leads to missed exits and poor execution. Without defined session limits, performance deteriorates quickly. Confusing scalping with revenge trading is another frequent issue. Fast losses can trigger emotional reactions, causing traders to click impulsively instead of waiting for valid setups. Finally, ignoring transaction costs and execution quality can destroy results. In scalping, spreads, commissions, and slippage matter. When these factors are not controlled, even a good strategy can become unprofitable. To wrap up, scalping is a trading style built around speed, precision, and execution. It is not about prediction or opinion, but about applying a small edge repeatedly under strict structure and controlled risk. This chapter was designed to bring clarity. Scalping rewards discipline, preparation, and emotional control, but it quickly punishes hesitation, impulsiveness, and lack of structure. Understanding these demands is essential before deciding whether this style truly fits you. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure. so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.